Hello, everyone. Good afternoon. Thank you for joining us today in this webinar. We have a very interesting discussion today. The topic is about building trust in energy efficiency investments through innovative financial solutions. And we have two organizations that have been working in implementing risk mitigation mechanisms to help this market, which basically is the LAUNCH project that has been led by Jules Assets, and as well the Energy Saving Insurance Europe project that has been led by BASE. So this is a very important topic in terms of trying to achieve the goals of the EU. As you know, there are around or more than 25 million enterprises in Europe, from which more than 99% are SMEs, companies, are small and medium-sized enterprises. Collectively, they consume quite a lot of energy, even though the amount of energy individually is not a lot. And there has been quite a lot of challenges for helping and supporting these organizations to access financing and motivate them to invest in energy efficiency. So we know that energy efficiency have a lot of risk perceptions from different stakeholders, from the decision maker, from the SME, as well as from the financial institutions. So we are going to be learning today two different ways to approach this risk and to motivate these different stakeholders to invest in energy efficiency. So we have first on the line to Michael Pashlatko. I hope that I pronounced it well, Michael, from Jules Asset. He's going to be giving a little bit of an overview of the LAUNCH project. Then later it's going to be talking Livia Mietke, who's going to be talking about the energy savings insurance. She's from BASE. As well, we have the privilege as well to have Quentin Nernix from BNP Paribas, that is going to representing the financial institution. And as well, we have Miguel Angel, which is representing Crédito y Caución, which is an insurance company in Spain that is offering an insurance for energy efficiency projects. So, Michael, the floor is yours.
Thank you very much, Daniel, for the kind introduction, and welcome everybody to this webinar. I will, in my presentation, just focus briefly on the background, how dual assets actually have come about to team up with other partners for the LAUNCH project. What were the key barriers that we saw in the market that we needed to address, and then also explain a little bit what a couple of these tools are that we have developed to address these barriers, and what some of the achievements are that we have seen and accomplished over the last couple of years working on this project. Dual Assets has been engaged in a number of initiatives over the last 5 years, always particularly focused on the matchmaking of project opportunities with suitable financial sources. We have seen an abundance of capital, an abundance of project opportunities, but we have always as well seen a lot of barriers, a lot of sticky points in the processing of these projects that led to delays, that led to also parties not agreeing and walking away without a successful project being completed. And so on the next slide, I present just a number of these barriers, and certainly a lot of them will look familiar to you. We need obviously to find a good match, suitable projects in the right country at the right time, the right technology. But it is not only a struggle for project developers, it is really also a struggle for investors to find the right project opportunities at the suitable size, at the suitable time for them. When we talk about risk, clearly credit risk, so that's the counterparty risk related to the end clients, the building owners, but also the contractors in the middle. This risk category is key for investors. They want to see proper financial statements, a financial track record, that they can trust that the parties will still be around for the full investment term in order to ensure sufficient and timely payback. Investment size is another key barrier, and as we have focused on predominantly project sizes of below 1 million euros, we see obviously that due diligence costs for investors can quickly outweigh the investment returns. And what we therefore really focused on is standardization, because only with standardization of projects, of project descriptions and related documentation, we can ensure as well a swift and smooth aggregation of projects into significant sizes that then are attractive to investors. At the same time, we have contractual terms that often really represent a time-consuming and also costly element in the underwriting process. Having to go through new client contracts for every single project incurs legal fees, and you know, it's again an area where we have seen a lot of projects fail. And therefore, a particular focus of the launch project was on the standardization of contractual terms for the end client contract. Finally, related to this, the debt burden. Debt burden on end clients, especially now with COVID-19 and the aftermath, that we only are now about to see how difficult the situation this all has created for small and medium-sized enterprises. It is a key value proposition for a project developer to approach a client with an off-balance sheet solution. So transferring over the asset ownership and therefore the liabilities linked to these assets away from the client's balance sheet to the contractor, and possibly also further down the road into securitization. Now, looking at these key barriers, I would just like to highlight two main project finance tools that Launch has developed. It is the standardized client agreement that I just briefly mentioned. It is an off-balance sheet agreement designed as a service agreement. So it's agnostic to any technology, but whether it's heating, lighting, cooling, it is being offered as a service and not as equipment. And therefore, this allows it to be truly off balance sheet. We have had an accounting opinion here from one of the big 5 accounting firms that has stated the compliance with IFRS 16 rules. At the same time, this contract allows for securitization, because it allows for the sale of receivables, so the reassignment of receivables that are generated to a third-party securitization vehicle, for example. And key here is really to have a standardized fixed body of this agreement that cannot be changed, which then allows aggregation not only within one project developer with several clients, but even across project developers. So clearly these are key elements that we're focusing on that tool. But closely related to the standardized agreement, we have developed a standardized risk assessment protocol that covers 17 different risk types, anything from credit risk to performance risk, technical risks and construction risk. And many of these risk types are closely related to the contractual terms as well, such as occupancy risk or change in control, what happens in such circumstances. So here, the key idea is to have a full and transparent risk communication right from the start that the contractor is providing to an investor when introducing a project opportunity. What we also have incorporated here is an industry benchmark ESG framework that is fully aligned with the EU taxonomy, just that we cover the ESG related factors as well for the investors in this regard. Just one more slide on the risk assessment protocol and the related process there. It is the contractor's job to go through the protocol carefully, fill in all the information on the various risk types, and provide supporting documentation for any of the claims that are made. The credit risk assessment obviously is a key factor of this. So we have developed a small set of financial ratios that can be computed and then handed over together with the protocol. But clearly the trade-off that we are seeing is that we have to develop something that is practical in use for the contractors and their end clients, while still being meaningful to investors in terms of having a complete and accurate representation of risk factors. And so the good news is, even though it's 17 different risk types and that it can look quite overwhelming, the majority of these risk-related information pieces are actually quite static across projects, because similar equipment will be used, similar contractual terms will be applied. And so once a contractor has actually taken the effort to really fill in a full protocol, many of the elements will actually stay the same, and it's gonna become much more easier to fill in for further projects. Now, just a quick slide on some of the achievements that we have seen. We have developed these tools over the last 2 years in Launch with a great number of practitioners in the field. We have engaged more than 360 stakeholders. We have quite a large investor board as well, with more than 12 billion euros of assets under management, specifically sustainable energy assets. And we have also organized a lot of outreach and collaboration events with partner projects, such as now ESI Europe, obviously. But it was really a co-creation process over these 2 years. And what we have been focusing on in the last few months is really to bring these tools to real life projects and have a real impact on some of the projects that our project developer partners have currently ongoing. And so we can expect to be closing by the end of October this year, when Launch comes to an end, to be closing 15 to 20 million worth of investments across a number of countries. Actually, the next slide will quickly just show this dispersion of where we have been active. You see clusters in the UK, clusters in Italy and in Greece, but we have already translated and transposed the materials, such as the contract and the risk assessment protocol, into 6 languages. That allows us also to tackle further countries and further markets. And just a final slide. It was already also shown on the very first slide. Launch is clearly just a stepping stone. All the 5 partners involved in the project are very eager to see how these tools can be further applied and further disseminated in the markets. And so we are very happy that we have secured an additional grant from the European Commission, and 4 out of the 5 launch partners will continue this work. Actually have just started last week on the Propel project. The Propel project will take on the Launch tools, such as the risk assessment and the contract, and integrate it into an IT platform that will then live on in a newly created Sustainable Energy Finance Association that we look to create in the months to come. And that will then be the European body, a center of competence, essentially, that carries on this work and carries on these standardized collaterals into the future. So that was, from my side, a quick introduction into Launch and some of the key challenges that we've seen and the tools that we have developed to overcome these. Thank you very much.
Thank you, Michael. Very, very interesting, all these tools and this approach that you have proposed. So next in line is Livia Mietke from BASE. She's going to be talking about the energy savings insurance as well. It's a project funded by the European Commission under the same window that the Launch project. So the floor is yours, Livia.
Thank you very much, Daniel. And yeah, here I am to talk a little bit about the ESI Europe project and our solution that we are bringing to the market, which is Go Safe with ESI. So as was mentioned, ESI Europe is the project that is funded by the European Commission Horizon 2020 program. We are 4 partners, so based as coordinator, and in Italy, Portugal, and Spain, we have our partners. It is the implementation of the ESI model in those 3 countries. And our objective is to create trust in energy efficiency investments, especially by small and medium-sized enterprises, and as a final goal, to drive investment in energy efficiency. But why is such a solution as Go Safe with ESI needed? I think we all know the benefits that energy efficiency investments have. So it is not only a matter of cost reduction and improve in operations and productivity, but there are also many other side benefits, the externalities that are reduced, the climate change, and further benefits. But still, we see that investment in energy efficiency is not happening. There are barriers, as Michael was also mentioned, especially in small and medium-sized enterprises. When making a decision into an investment, energy efficiency is rarely a priority. It's much more likely that decision maker will invest in their core business. This is also due to high upfront costs, so more efficient equipment, they cost a little bit more. And there is this lack of trust that the future energy savings will be achieved. So if technology provider comes with a solution that is more expensive and the decision maker has to believe that those future savings will be delivered and take all the risk in taking a loan for buying this more efficient equipment, that there is like this huge barrier and the lack of trust among the actors. So how does Go Safe with ESI tackle this issue? So it's a combination of financial and non-financial instruments, as we see that this relationship between technology provider and client is guided by this agreement that both signed. So we have developed this standardized contract where the agreement is clearly set and the guarantee is provided by the provider on the future energy savings. This guarantee is then covered by an insurance product, and there is also an external technical validation entity involved to provide create the trust on the technical aspects of the project, and it is all linked to green financing. So it's this combination of the elements that represent the Go Safe with ESI solution that tackle the matter of the trust in energy efficiency investment. So shortly, I'll go through here how it works. So when a technology provider presents a project for a client and they use the Go Safe with ESI contract where the guarantee is presented to the client, they both agree on the terms. The contract is activated when the future energy savings, the promised energy savings are validated, and the insurance company can then issue the guarantee covering the validated energy savings. Then with the contract activation, there is the implementation phase, so the provider can go and install the equipment at the client's premises, and the validation entity steps in again to verify that this installation is according to the contract, and all the monitoring equipment are also in place to track all the savings that will be achieved. In the operation phase, the client can benefit from all the energy efficiency benefits, and the provider is also performing the maintenance of the equipment, ensuring that it's operating optimally. And yearly, the provider also compiles the information regarding the savings and reports the savings achieved during the operation of the equipment. With this, the client can go and approve the savings achieved, and everything is fine. But in case the client does not approve, if there are any disagreements on the achieved savings, it can be triggered an arbitration process, and the insurance coverage can be also then coming in to cover the non-achieved saving, if it's the case, to the final client. So the client has the security that it will receive the savings at some point. So just going quickly through the elements in more detail. So the Go Safe with ESI contract is structured on a standard supply and installation and maintenance contract. We have in the 3 countries, in Italy, Portugal, and Spain, developed it with local law firms, and have gathered through consultations, workshop, the feedback from technology providers and from final clients associations. In the ESI Europe toolkit, we have a version that is in English that can be then adapted to other countries in their local conditions. The validation process here, we are working in the ESI Europe project with SGS, which is a certification body, and we developed with them the general methodology of the Go Safe with ESI process, and handbook based on technology. So the validation process is, the validation methodology is based on technologies, but it can be applied in combination. And here we see that the validation entity acts in several stages, as I've explained in how the process works. And most especially is the actuation in the arbitration process. So the validation entity is there also to give the security to the insurance company that they will be paying savings that were not achieved, and also to increase the trust also by the financial institutions. They don't need to make assessments of the technical aspects of the project. And here is this important role of the validation entity in creating trust. The energy savings insurance, here I'll be just very briefly showing you, as we will have later the presentation of Miguel to go into more detail. So it is this 3-party surety element, that the beneficiary is the final client and the insurance taker is the provider. So the final client will be secured in the savings that were promised by the provider. Regarding the financing structure of the ESI Europe approach in Go Safe with ESI, so here it's the client who is the credit taker, and the investor in the technology and in the energy efficiency upgrade. And here the model gives the flexibility of linking with incentives or existing green credit lines from financial institutions. And here is where we work in the 3 countries with financial institutions offering those products. Or there was also a case of the creation of new products, especially for a Go Safe with ESI solution. So that model allows an easy adaptation for other markets as well, this configuration. So finally, we are also developing a management information system within the ESI Europe project to facilitate the flow of information, like the validation steps and the approval of reportings. And that will also be tracking the savings along the time. And that is very valuable information for ESG reporting or any type of reporting on the benefits of energy efficiency. And so for the ESI Europe project, we had this goals of setting up the mechanism. So here I really just gave a very brief explanation of what it is. We worked in the 3 countries to set up the model with consulting the stakeholders and the market actors, doing capacity building sessions. So our goal is still to mobilize private investment. We are building the pipeline with pilot projects, and we have created Go Safe with ESI, which is this brand that will live on when the ESI Europe project finishes by early next year. And we are also envisioning the replication of the ESI model to other countries. So we were also granted additional funding for implementing Go Safe with ESI in Greece, Croatia, and Slovakia. So from September on, we will be working on the expansion of the ESI Europe project. And yeah, all the lessons and learns and all those standardized tools, we have also bundled it in the ESI Europe toolkit, which will be then also very much valuable for the replication of it. And that's my last slide.
Thank you very much, Livia. Thank you for the overview on the energy saving insurance, and as well to Michael for giving this overview of these 2 different models. And now we are going to have 2 financial institutions giving their point of view on the practical part. First, we will have Quentin from BNP Paribas, that he's going to be talking a lot about the implementation, the standardization, implementation of these tools to try to reduce risk and as well reduce transaction costs. And then we will have Miguel Ángel Medina from Crédito Caución, which is one of the insurance that has been in the upfront offering performance risk mitigation coverage for energy efficiency. So Quentin, the floor is yours.
Thanks, Daniel. Well, I will present a bit what's the financial point of view for the risk assessment protocol for our financial institution. I will do that from 3 points of view, effectively. The point of view of the investors, point of view of the junior debt provider, and of the bank. And why? Because in energy performance projects, especially non-recourse energy performance projects, we usually see the 3 roles. You have the developers, and then you have the financial guys, which have different roles. And all these roles will have different implications in terms of return and in terms of risk assessment. And that's a bit what we will try to do today. The golden rule in finance, quite basic, but it's very important to integrate that. It's that a higher risk is rewarded by a higher return. So if a bank said to you, there is too much risks, it doesn't mean that in the point of view of a financial institution that it's not possible to finance it. What it does mean is that the return the bank has for this credit is not high enough considering the risk. And once you understand too that, it changes a bit the perspective on the way you have to speak with financial institutions with investors. That's the consequence is what? It's the risk appetite, which depends on the returns expectation. And you have different return expectation, and it will be based on the consequences. For example, an equity investors. Somebody will invest with you in the equity. If the project fails, he loses its investment. Okay, there is no point in it, he loses everything. But if it succeeds, its return will depend on the success level. And so he has a bonus on the success. The junior debt investors, so somebody will provide a debt, but a debt which is not which has no priority, he will also lose all his invested money. But he could ask, because he has no securities, a higher interest rate. The bank, if the project succeeds, doesn't win anything else than the interest rate. So the bank has no bonus in the success, but as naturally a high risk in case of failures. And that's why this different type of investor, we have different risk appetite. I will provide an example. In Belgium, we have a strong health tech business. There is a strong health tech community. We have a lot of investors in health tech. Why? Even if you speak about startups with non-proven technologies, but with a potential very high upscale. And so investors, they see the risks, but the risk is compensated by the high upscale, which is possible. Even the banks in Belgium will sometimes lend to the health tech sector. Why? For example, even if these startups doesn't have any products, why does the bank do that? It's just because the bank has the security. For example, if a bank has to finance a laboratory, okay, we know that the health tech sector is strong in Belgium, so this laboratory will be able to be resold to another actor. If you compare that with the energy performance market, what you have, is there a lot of upscale in energy performance projects? No, there are not a lot of upscale in energy performance projects. Okay, probably will the project be able to have 10 or 20% more than expected in savings, but it's not a lot compared if you take the biotech to the 200, 300% extras you can have in such projects. It does the assets that we finance as bank any residual value? No. If you finance a boiler in a building, once installed, this boiler has no value. It is the same for the LED lamps, etc. So you see already that energy performance project will not be able to attract a lot of higher returns. What it means that in order to attract investors, it's absolutely necessary to really focus, identify, and mitigate the risk. Because if the risk perception of the project is too high, you will not attract any investors nor any bank. What does see the equity investors? Equity investors will focus on the valuation. Is the risk return balanced? And so, depending on that, you will ask, okay, for this price, I will take 20, 30, 50% of the equity value. You know that investors will raise or lower their interest rate. Higher risk, higher interest rate. What's the problem here? If the project is not profitable enough, it will not be able to pay this higher interest rate. So it will block also the project. And the bank, what will the bank say? They will check all the risks are mitigated and what's the residual value. And the answer of the bank will not be, I will take more or less equity, I will give you an higher of a smaller interest rate. The bank will just say yes or no. Yes, I am comfortable enough to finance you, or no, I'm not comfortable enough to finance you. And again, it's a bit a different perspective in this case of things. And that's why a good risk assessment is really important. If we are going to the investor and saying, oh, but the risks are all mitigated, very good. But the investors will have to know which risks are mitigated, which risks are not mitigated. And this last thing is very important because it's okay to have risks. It's okay that some risk remains open, but it's not okay to have these risks not identified and to have the impact of these risks not identified, not calculated on the project. Because if you do that, if you don't do that yourself, you will let the investors or the bank do that. And it will not be in your favor because they will take far more precautions that you will do as a developer of a project. In Launch, as Michael said, we proposed several methods to mitigate different risks. So in Launch, we developed and identified several risks, typical standard risk for such project performance project. And we tried to identify, okay, that's a way to mitigate the risk. The Launch project and the standard documentation provided by the Launch project also contains ways to mitigate these risks in order to allow more flexibility, because standardization in this kind of projects is really, really key. And so what's the content of this risk assessment protocol here? We've mapped different type of risk. Regulation risk, okay, that's regulation. It depends on credits. It depends on countries, per countries. It's more, okay, it has to be known, but it's more easy to assess. Then you have what we call the macro risks. It's the currency. Is there a change of liquidity? Does the rate change, etc.? Okay, for Europe, are situated in the eurozone, it has less an issue. Country risk. Is the country where I invest stable? Okay. Market risk, energy price risk are a bit linked. Is how will these risks evolve? And how, and more important, are these risks mitigated? Usually in an energy performance contract, the energy price risk will be will stay on the shoulders of the end user. So the developer, the investor, will not have any risk on the energy price risk. It's the same for the climate risk. If the weather is more cold, or the weather is warmer than what's foreseen, this variation should stay in the responsibility of the end user. Why? Just because it's risks that cannot be assessed in this case. And so it is quite logical that the end user stays with this risk. It's not an application, so it could also vary, but this has to be explained. Then we have a very, very important risk, and probably the most important risk of such transaction is the end client risk, so the end users. And there you really have to assess what's the credit risk of my client. Will my client still exist in 10 years, in 15 years? Will he still be able to pay me? And that's very important, because if you install solar panel, for example, it's a bit less important, because solar panels produce electricity. You can, in some condition, always sell the electricity to the grid. But for an energy performance project, the only cash flows you will receive comes from the end user. So if your end user disappears, you will really be stuck. But it's a huge risk. Then you have different less important aspect, but still to be seen, the occupancy, interface, and prepayment risk, which are linked to who bears which risk. Who bear the risk that the building is not used as it should? Who bear the risk that the prepayment during the construction are not paid, etc., etc. Finally, the escrow risk, the risk of the developer, which has also a credit risk, the credit risk of the contractors, and then all the risk related to the follow-up of the project in the performance risk, maintenance risk, technical risk. All these risks, we have tried to describe them and to propose some ways to mitigate. Yeah, okay. Okay, I missed one slide, sorry, but I will change that where I explain. So what we have done with this different type of risk, we have tried to have always the same structure with a first description of the risk, an explanation how we think this risk could, what's the impact of this risk, is the impact of this risk important or not really important? And afterwards, a way to mitigate this, and finally some documents and which documentations could be. What's the use of this kind of methodology for a bank, of a financial? First, it will help you to know your own risks, and it's very important to do that. To structure or see the discussion with the financial guide. Well, once you do that, you will be able to profile yourself as professional, because the investors before you will say, okay, this guy, I really think this true. He knows where it's going, because when a financial guy see that your counterpart has an awareness for the risk, it will be far more easier for him to trust you. And once you do that, effectively, you will be able to optimize the valuation, because if the risk perception of the investor is good, so if the investors perceive your risk as an acceptable risk, as a low risk, it will be able to lower its price. And as energy performance project doesn't have a high return, it's really important to have all the cost of such project as low as possible. And in order to close a bit this first view on risks and investors and risk assessment protocol, I would say that for a bank or an investors, having a risk is not a big deal, but to have a risk which is not identified, that's where the real issue is for us, just because then we are in the black, and we don't not really like that. Voilà. Thanks a lot.
Thank you very much, Quentin. Very interesting, the presentation. So now we have Miguel Ángel Medina from Crédito y Caución. He's going to be talking about the energy saving insurance and the implementation in Spain. So Miguel Ángel, the floor is yours.
Hello. Good afternoon, everyone. Let me see. Okay. So we, as Livia was mentioning before, here in Spain and in some other countries, there's an insurance solution for covering energy savings. We are a partner of GoSafe with ESI in Spain, and we have collaborating with them in the construction of the contractual framework standardized that Livia has already explained before, mainly in the part of the insurance cover, which is indeed a type of surety insurance that we have created jointly with a law firm here in Spain. So let me introduce an overview of who we are. So we are Tradius Crédito y Caución, which are one of the world's leading credit insurers and surety providers in the world. So we are active in more than 50 countries, and we are part of Grupo Catalán Accidente, which is an insurance group, a Spanish insurance group with a strong financial position, rating Moody's A2 and AM Best A. We are experts in providing surety tailor-made solutions, and this project was really attractive because it was something that we didn't do before. We know there is a high demand for these kind of initiatives right now. So energy savings, ESG projects are really highly demanded in the market. So we offer ourselves to collaborate with them as a partner. So just to explain you what's a surety bond, which is the instrument that we use within this context of energy savings contracts in Spain. So surety bond is basically a security that we offer to the customers, to the clients, to a third party, and they are normally included in the context of a contract. So it's an instrument to secure the contractual obligations for a third party. If in this case the technology supplier doesn't fulfill the contractual obligations, the insurance entity has to give a monetary compensation to the beneficiary, which is the customer of the technology supplier. So it is an instrument which is similar to the bank guarantees, but with some advantages. And it's a supplement of the cash retention or cash deposits. So the surety bond secure the performance of the contracting party towards the beneficiary, towards their customer. So the performance of the obligations within the contract. Increase the credibility and improve the relationship with the partners of, in this case, the technology providers. Also increase the liquidity and flexibility, as there is no impact on the bank limits. So we can free some credit capacities, which probably for this kind of projects can be focused on financing the projects, and then use the insurance companies for the securities or the surety bonds. So there's no need to provide tangible securities for the issuance of a surety bond, and it's a security for the customers to make much more attractive the possibility to invest in energy efficiency. So we all know that some of the companies that probably are studying to make one of these projects, probably they have some reluctancy because they don't have security that covers the potential or the guaranteed energy savings. So in here, the surety insurance is where we play our role. So let me explain you briefly what is the validation process. So first of all, we have a technology provider which negotiates with the customer an energy savings contract under the Go Safe with ESI standardized contract. So normally it's for supply and maintenance of equipments that guarantee energy savings. So once they have get an agreement, the entity which is managing this program contact us. They send us the financial information and the technical information in order to perform a risk assessment. So we underwrite the risk assessment, the technical risk assessment, and the credit risk assessment. So in that sense, we generate a contract between the technology provider and our entity, which is the bonding contract or the policy, under which we establish a bonding facility. So this is the maximum limit up to which we can issue surety bonds to cover different contracts for different projects for the same technology provider. So once everything is in place and we get the confirmation from the validation entity that the projects is already certified by them, that the energy savings guarantee can be met with this project. So then the cover starts, okay? So the cover starts until, and it lasts until the last year of those of the ones that are included within the contract. So, for instance, we have a technology provider that ensure some percentage of energy savings to their customers for 5 years, the insurance cover is going to last all those 5 years. Okay, and what we are covering here with this instrument is the effective energy, so that the client, so we guarantees the client that the effective energy performance of the equipment installed by the supplier is, if it's lower than the guaranteed energy performance for reasons not attributable to the customer. So if the guarantee energy savings, energy performance is not met, then they can call the bond. If they can call the bond, is because there's a non-fulfillment of those energy savings and they are certified by the validation entity, and they are not attributable to the customer, only to the technology supplier. So the customer notifies the supplier, and if they don't fix the situation, then the customer can call the bond. So they ask us for the indemnity. So we perform the indemnity payment, and as in all the guarantees and in all the securities, we ask the reimbursement to the technology supplier. It's key here. The role of the validation entity is really key, because they are going to certify, to make to act as an arbiter for the cases that there is some dispute. Okay, and the validation entity certifies that those here the non-fulfillment is based on the technology supplier, is caused by the technology supplier and not by the customer usage. And also the validation entity will certify the amount of indemnity that we have to pay. And that's it from my side. Thank you very much for your attention.
Thank you very much, Miguel Angel. Very interesting indeed. What Crédito y Caución is trying to do here, and as well BNP Paribas standardizing the evaluations and risk mitigation processes. So we have already some questions. We have 5 minutes. So hopefully we manage to go to some of these questions. I'm gonna start with a question to Miguel Angel on how does the insurance calculate the annual premium of the insurance? So can you respond that, Miguel Angel?
Yes, sure. The calculation of the annual of the pricing or the annual rates, premium rates, are based on the risk assessment. So depending on the risk profile and the credit rate and the credit ratings, we establish the price for the insurance cover. So yeah.
Thank you. Here we have another question. Probably this one is for Livia. Is there a minimum contract value to cover the cost of the certification and insurance?
So when we are talking about Go Safe with ESI project, the sizes of the project, they need to be a certain size. So it makes sense that those additional costs, yes, they are additional costs, the validation process and the insurance. So here we are talking about projects that are around or 1,000 or 100,000 euros. The minimum, we would say, like they could be lower, but then it would be kind of, yeah, taking all the advantage of the savings that can be achieved. So we want not to go below, for example, 30,000 euros of investment size.
Thank you, Libri. I have a question as well for Michael. Michael, what has been the feedback from project developers about the amount of effort involved in filling all this risk assessment protocol?
I have to admit, it has been at first a little bit critical. Clearly, people were feeling that on small actions, small projects, it was an overkill to go through all these details. But we have in the launch project really put a lot of effort into kind of what we call the launch education program. So we really kind of took project developers on a journey. And I guess a key element in this was as well to really show them that investors such as Quentin from BNP Paribas Fortis are interested in seeing this information. And so the chances of successfully getting a deal closed are just significantly increased by using such a tool. And so, yeah, clearly there is a big first step, but then afterwards, once people see the value and we can facilitate, the replication as well of the information across projects, that is definitely positive.
Thank you, Michael. And the last question for Quentin. Quentin, what is your view in terms of the measurement? Who should be doing that? It should be this part of the ESCO, or should be separated from the ESCO activities, the monitoring and reporting?
Yeah, usually one way to mitigate the ESCO risk, so the risk that the ESCO is in default, is to have a step in right where we can find another ESCO to do the same work. But this means that the objectivity of the measurement has to be proved. And so in this case, it could be useful to have a facilitator, an independent assessor, which measures the performance without the ESCO, without taking account the ESCO, so that you have some measures which are really not objectivable, where you can not contest it. And that's very important, because for this kind of project, if you have to go to court, if you have a dispute and you have to take years to go in legal process, it's just not possible. It's just not feasible. So to have an independent facilitators is really, according to me, a huge added value.
Thank you, Quentin. I think the time is over now. We have still some questions. We are going to pass it to the speakers and presenters so they can respond this directly. And please feel free to approach each of them directly to address your questions. Thank you very much for participating in this webinar, and we look forward to see you in the next one. Federica?